There is a moment in every great investor's life, a single point in time that defines their entire career. It's not a moment of celebration, not the ringing of a bell on Wall Street, not a triumphant headline in a financial newspaper. It is a moment of profound and terrifying silence. It's the silence that follows a crash. The silence when the screens are all red, when the pundits are speechless, when the life savings of millions have seemingly evaporated into thin air. In this silence, the vast majority of people feel only one thing: gut-wrenching, paralyzing fear. But for a tiny few, for the true masters of the game, this silence is not an ending. It is the starting gun. It is the moment the entire world changes, when the financial landscape is reset, and when the fortunes of the next generation are forged. For Warren Buffett, the master of them all, this silence is the sound of opportunity. For decades, the world has studied Buffett's every move, trying to decode his genius. They talk about moats, about management, about long-term holding periods. And they are all correct. But they are missing the engine. They are missing the one tool he has wielded with more devastating effectiveness than any other. The secret weapon that allows all his other strategies to function. It's a tool so simple, so overlooked, that most people dismiss it as boring, as unproductive, as dead weight. That tool is cash. Not cash as a safety blanket, not cash as a place to hide, but cash as an offensive weapon, cash as a coiled spring, held down by immense discipline during the good times, waiting to be unleashed with ferocious speed and power when the world is consumed by panic. The central mistake that prevents 99% of investors from ever achieving true financial freedom is the belief that they must be 100% invested, 100% of the time. They are told that cash is trash, that it gets eaten by inflation, that every dollar must be working for them. And so they construct their portfolios like a brick wall, solid and immovable. But when the earthquake of a market crash hits, that wall does not bend. It shatters, and they are left standing amidst the rubble, a passive, helpless victim of the market's fury. They can only watch as the greatest bargains of their lifetime appear on the clearance rack, priced for pennies on the dollar. They have the knowledge, but they lack the firepower. This is where the transformation begins. It begins by fundamentally rewiring your brain to see the financial world not as they tell you to see it, but as it truly is. You will learn to see cash not as a zero-return asset, but as a zero-premium call option on future bargains, an option with no expiration date. You will no longer fear a bear market. You will welcome it with the calm, predatory patience of a hunter. This is the final promise. By the end of our journey together, you will understand how to use market crashes to get rich, and cash will become your secret weapon. You will learn to operate in the silence, to act when others are frozen, and to turn the market's greatest moments of fear into your greatest moments of profit. Let us begin with the first pillar of this fortress of financial thought, recasting cash not as a shield, but as the sharpest spear in your armory. To understand this, we must first abandon the pedestrian definition of cash as simply idle money. We must elevate our thinking and see it as Buffett does, as a claim on future opportunity, a strategic tool of immense power. The most potent way to grasp this is through the analogy of a call option. In the world of finance, a call option gives you the right, but not the obligation, to buy an asset at a predetermined price. You pay a small fee, called a premium, for this right. Buffett's strategic cash reserve is like a call option on everything. It is a call option on stocks, on bonds, on entire businesses. But it has three magical qualities that a normal option does not. First, he pays no premium for it. The only cost is the opportunity cost of not being invested, a cost he is more than willing to pay. Second, it has no expiration date. He can wait for years, even a decade, for the perfect pitch. And third, the strike price isn't fixed. It is whatever ridiculously cheap price a panicked market is willing to offer him. Holding cash, in this light, is not a passive act. It is an act of profound, aggressive patience. It is the conscious decision to trade small, predictable, and often illusory gains in a calm market for the chance to seize massive, life-altering gains in a chaotic one. To truly cement this idea, we must travel back in time to a moment of crisis, a moment when one of Wall Street's titans was on its knees, and Warren Buffett, armed with his weaponized cash, was the only man who could save it. The year was 1991. The swaggering, high-octane world of Wall Street was dominated by a few behemoth firms, and none was more formidable than Salomon Brothers. They were the kings of bond trading, a ruthless, brilliant, take-no-prisoners institution led by the man Tom Wolfe immortalized as the master of the universe, John Gutfreund. Salomon was the embodiment of the era's ambition and excess. But in August of that year, their universe began to collapse. A scandal erupted. It was discovered that a rogue trader at Salomon had been submitting false bids in U.S. Treasury auctions, a flagrant violation of federal law that threatened the integrity of the entire government bond market. The news hit like a thunderclap. The Treasury Department barred Salomon from bidding on government securities, effectively cutting off their lifeblood. Confidence in the firm evaporated overnight. Their clients, their creditors, their counterparties all began to flee. The firm was facing a full-blown liquidity crisis, a bank run on an investment bank. In a matter of days, one of the proudest names on Wall Street was facing imminent bankruptcy. John Gutfreund was in a state of utter panic. His firm was dying, and he was out of options. In his moment of desperation, he made one last phone call. He called Omaha, Nebraska. He called Warren Buffett. Buffett was already a major shareholder in Salomon, holding a $700 million stake in preferred stock he had acquired a few years prior. He was not just an investor, he was now the firm's only hope. What happened next is a masterclass in deploying cash as a strategic weapon. Buffett didn't just offer to lend them money. He understood that what Salomon needed was more than capital. It needed credibility. It needed the world to know that the smartest investor on the planet was willing to stake his name and his fortune on their survival. Buffett flew to New York that weekend for a series of marathon meetings. The situation was dire. The firm was bleeding cash. The Federal Reserve was threatening to shut them down. While everyone else saw a dying company tainted by scandal, Buffett saw an essentially good business, bond trading, underwriting, investment banking, that was being sold for a song because of a correctable management failure and a tsunami of fear. He saw the underlying value obscured by the panic. So he made his move. He agreed to step in as interim chairman to clean up the mess, a move that immediately calmed regulators. But more importantly, he deployed his capital. Yet he didn't just buy their cheap common stock on the open market. That's what an amateur does. Buffett, using the immense leverage his cash position gave him, structured a deal that was almost breathtaking in its genius. He injected another massive sum of his own capital, but on terms that only he could command. He received convertible preferred stock that paid him a handsome dividend, shielding him with downside protection. But it also gave him the option to convert that stock into common shares at a predetermined low price, giving him all of the upside if, or when, he turned the firm around. He wasn't just buying an asset, he was buying an asset with built-in safety and explosive potential. He was being, as he famously said, greedy when others are fearful. His cash wasn't just a pile of money, it was the key that unlocked a private, bespoke opportunity unavailable to any other investor in the world. He provided the capital and the seal of approval that saved Salomon Brothers from extinction. And in return, he walked away with a profit that ran into the hundreds of millions of dollars. This wasn't just a good investment. It was a strategic execution of the highest order, made possible only because he had the cash on hand, ready to strike when blood was in the streets. He saw the crisis not as a threat, but as the ultimate buying opportunity. He transformed his cash from a static number on a balance sheet into an active, history-shaping force. The Salomon Brothers anecdote reveals a deep psychological truth about markets, a truth that Buffett understands at a cellular level and that most investors completely ignore. To grasp why his cash as a call option strategy works, we must delve into the very wiring of the human brain. At the heart of it all is the concept of optionality, a term brought into the mainstream by the philosopher-investor Nassim Nicholas Taleb. Optionality is simply having the right but not the obligation to take a course of action. What makes it so powerful is its asymmetry. Positive optionality exists when the potential upside of a choice is far greater than its potential downside. The downside is known and capped, while the upside is unknown and potentially infinite. Think of a movie ticket. Your downside is the cost of the ticket, say $15. But the potential upside is 2 hours of profound entertainment, inspiration, or joy, an experience whose value is almost limitless. Holding cash in a portfolio is the ultimate form of positive financial optionality. The downside is known and relatively small, the slow erosion of purchasing power due to inflation, and the opportunity cost of gains you might have missed in a rising market. But the upside is spectacular and uncapped. It is the ability to purchase the world's greatest businesses at prices that seem impossible just months earlier. It is the ability to do what Buffett did at Solomon, to name your own terms, to get preferred dividends and warrants, to seize opportunities that can generate 500% or 1,000% returns in a few short years. You have the option to buy anything, but the obligation to buy nothing. Now contrast this with the psychological state of the fully invested individual, the person who follows the conventional wisdom that cash is trash. They don't have optionality. They have its sinister twin, negative optionality. Their position is one of obligation without rights. When a market crash occurs, their upside is capped. The best they can hope for is that the market stops falling, but their downside is terrifyingly open-ended. They are obligated to ride the market down, feeling every sickening lurch in their stomach. They have no choices. They cannot buy more because they have no cash. Their only available action is to sell, to capitulate, often at the point of maximum pain, turning a paper loss into a real, permanent loss of capital. They are a prisoner of the market, while the cash-rich investor is its master. This asymmetry is driven by one of the most powerful and primitive forces in the human psyche, the fear of the unknown. When markets are calm and rising, the future feels predictable. But in a crash, the future becomes a black box of terrifying possibilities. The fully invested person is locked inside that black box. The person with cash is standing outside, holding a flashlight and a checkbook, deciding whether the contents of the box are worth buying. This cerebral understanding of optionality is what allows Buffett to sit calmly on billions of dollars year after year, enduring the condescending remarks of pundits because he knows he is not sitting on dead money. He is sitting on the world's most powerful financial option. Translating this profound psychological insight into a practical strategy requires a deliberate and disciplined mental model. Let's call it the dry powder blueprint. This is not just a set of rules. It's a new operating system for your financial life, a way to internalize the offensive nature of cash. The first step is the most critical, a radical act of relabeling. You must go into your personal balance sheet, your spreadsheet, your financial app, and you must change the name of your cash account. It is no longer savings or uninvested funds. It is now strategic opportunity capital. This is not a semantic game. Words shape our reality. By renaming it, you are telling your brain that this money has a specific, aggressive purpose. It is not there to be spent on a vacation or a home renovation. It is not there to make you feel safe. It is there to make you rich. It is your war chest, your ammunition, your strike fund. Step 2 is to bifurcate this fund. You must separate your sleep-at-night money from your strike fund money. The sleep-at-night money is your standard emergency fund, 3 to 6 months of living expenses, kept in a completely safe liquid account. This money is purely defensive. It is there to handle job losses, medical emergencies, or unexpected repairs. It is your castle wall. The strategic opportunity capital, however, is your army. This is the capital over and above your emergency fund. The size of this army will vary depending on your personal risk tolerance and financial situation. But a good starting point for many within a broader wealth management framework is to think about holding 5% to 25% of their investable assets in this fund. This is the capital that you will deploy during a market crash. To reinforce this separation, the third step is to physically ring-fence it. Open a separate high-yield savings account or a brokerage settlement fund specifically for your strategic opportunity capital. This physical separation prevents the mental accounting error of seeing a large cash balance in your primary brokerage account and feeling an impulsive need to put it to work. By isolating it, you protect it from your own worst instincts. The final and most empowering step of the dry powder blueprint is to create your dream asset hit list. The biggest problem investors face during a crash is analysis paralysis. Everything looks cheap, and the fear of choosing the wrong thing is overwhelming. You must do your homework during times of peace to prepare for war. Make a list of 10 to 15 incredible businesses that you would love to own for the next 20 years. These are the fat pitch companies, businesses with durable competitive advantages, strong balance sheets, and excellent management. For each company on your list, do the valuation work now. Determine a price, a no-brainer price at which you would be ecstatic to buy a significant stake. Write it down. For example, I will buy Company X if it ever falls below $150 per share. Now you have transformed yourself from a passive observer into a patient hunter. You are no longer reacting to the market's whims. You have a plan. You have your capital segregated and properly labeled. You have your hit list and your strike prices. Now all you have to do is wait. The market's panic is no longer a source of fear for you. It is the trigger for your meticulously prepared plan of action. This is how a retail investor begins to think and act like a professional in capital allocation. To fully appreciate the wisdom of this blueprint, we must examine its opposite. We must walk the well-trodden path of the 99%, the path of the perpetually and fully invested. This path is paved with a dogma that is preached from the highest pulpits of personal finance. You can't time the market. Therefore, the logic goes, the best strategy is to be 100% invested in a diversified portfolio at all times. This advice, while well-intentioned, is a recipe for mediocrity and, in times of crisis, for disaster. It is born from an oversimplified interpretation of the efficient market hypothesis, the academic theory that asset prices fully reflect all available information. If markets are perfectly efficient, then there are no bargains to be had, and holding cash is a fool's errand. But Warren Buffett's entire career is a testament to the fact that markets are not always efficient. They are often, especially at their extremes, wildly emotional and inefficient. The dogma of being fully invested turns you into a passive rider on this emotional roller coaster, rather than its operator. Consider the journey of an investor in the late 1990s, during the peak of the dot-com bubble. They were told that, quote, "this time is different," that old valuation metrics no longer applied. They were told that holding cash was a cardinal sin, as technology stocks doubled and then doubled again. So they poured all their money into companies with no profits, no tangible assets, and often no coherent business plan. They were fully invested. They felt like geniuses. Then, in March of 2000, the bubble burst. The Nasdaq, which had soared above 5,000, began a brutal, soul-crushing decline that would not bottom out for 2.5 years, ultimately falling nearly 80% to below 200. The fully invested individual watched in horror as their portfolio was incinerated. But the financial pain was only half the story. The true tragedy was the opportunity cost. While their tech stocks were collapsing, rock-solid old economy businesses, the very kind Buffett owned, were also being sold off, trading at incredibly cheap prices. But our fully invested hero could do nothing. They had no cash. They were trapped, forced to watch the sale of a lifetime from the sidelines. Their rigid adherence to the always invested rule had rendered them powerless at the exact moment when power mattered most. The same story played out in 2007 with investors who were all in on real estate and financial stocks. When the great financial crisis hit, they were not just observers, they became forced sellers, liquidating their holdings at the worst possible time to meet margin calls or simply out of sheer terror. The path of the 99% is a path of reactivity, of being a victim to the market cycles. It guarantees that you will be a buyer at the top when greed is rampant, and a forced seller, or at best a paralyzed observer, at the bottom when fear is rampant. It is the antithesis of contrarian investing and a surefire way to sabotage your long-term wealth building. The financial consequences of these two opposing philosophies are not small, they are staggering. The difference is the chasm between modest wealth and true financial freedom. Let's quantify the power of viewing cash as a call option. Imagine two investors, Investor A and Investor B, at the beginning of 2007. Both have a portfolio of $1 million. Investor A, following the conventional wisdom, is 100% invested in an S&P 500 index fund. Investor B, following the dry powder blueprint, is 80% invested in the same index fund, but holds $200,000 or 20% of the portfolio in cash as strategic opportunity capital. Through 2007, as the market grinds to its peak in October, Investor A is slightly ahead. They mock Investor B for the cash drag on their portfolio. Then, the storm hits. From October 2007 to the market bottom in March 2009, the S&P 500 falls by roughly 55%. Investor A's portfolio, once worth $1 million, is now worth approximately $450,000. They are in a state of shock and despair. Investor B's portfolio has also suffered. Their $800,000 in stock is now worth about $360,000. But they also have their $200,000 in cash. Their total portfolio value is $560,000. They are down, but they are significantly less down than Investor A. But this is where the story truly begins. At the point of maximum pessimism in March 2009, when headlines are screaming about the end of capitalism, Investor B executes their plan. They deploy their $200,000 of strategic opportunity capital, buying into the S&P 500 at its generational low. Investor A does nothing. They are frozen, hoping just to get back to even. Now let's fast forward 2 years to March 2011. The market has staged a ferocious recovery, roughly doubling from its low. Investor A's portfolio has also doubled and is now worth around $900,000. They are still underwater from their starting point 4 years earlier. They feel exhausted and are just relieved to be almost whole again. Investor B's original stock holdings have also doubled, back to $720,000. But the $200,000 they invested at the bottom has also doubled and is now worth $400,000. Their total portfolio value is $1,120,000. Not only have they fully recovered, but they are now substantially wealthier than they were before the crash. They have created over $200,000 of pure alpha, a direct result of their strategic cash position. Over the next decade, as the bull market rages on, this gap will only widen due to the power of compounding. The cash didn't just act as a defense. It was a powerful offensive tool that allowed Investor B to fundamentally alter their long-term financial trajectory. This is the direct financial connection. This is how a simple shift in mindset, from viewing cash as a burden to viewing it as a weapon, translates into a tangible and massive financial advantage. The ability to maintain and deploy this strategic cash reserve is predicated on navigating a treacherous psychological landscape. The opportunities Buffett seizes are not created by faulty spreadsheets or flawed valuation models. They are created by raw, primal human emotion. A market crash is not a financial event, it is a psychological event, a mass contagion of fear. To understand why everyone sells when they should be buying, we must first dissect the anatomy of panic itself. This brings us to the second pillar of Buffett's philosophy: understanding the psychology of fear to exploit the opportunities it creates. The core reason these once-in-a-decade buying opportunities even exist is because, for a brief period, the market ceases to be a weighing machine and becomes a voting machine driven by sheer terror. rational analysis is jettisoned in favor of a herd-like stampede for the exits. To master this pillar, one must become a student of human behavior, recognizing that the greatest inefficiencies in the market are not numerical, but emotional. And there is no better story to illustrate this principle than one of the earliest and most daring investments of Buffett's career, a time when he stood nearly alone against a tidal wave of panic threatening to drown one of America's most trusted brands. The year was 1963. A young Warren Buffett was running his small investment partnership out of Omaha. He was not yet a household name, but he was quietly building a phenomenal track record. In the financial world, American Express was a blue blood, a bedrock institution. Its travelers' checks were as good as cash, a symbol of American financial integrity around the globe. But then, disaster struck, from a completely unexpected quarter. A company called Allied Crude Vegetable Oil, a major customer of a warehousing subsidiary of American Express, defaulted. This was no ordinary default. Allied's president, a man named Tino DeAngelis, had perpetrated one of the most audacious frauds in history. He had been borrowing vast sums of money against his company's inventory of salad oil. The problem was, the inventory didn't exist. The giant storage tanks, which were supposed to be full of valuable oil, were mostly filled with seawater, with just a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied collapsed, owing its creditors, including American Express's subsidiary, a staggering amount of money, over $60 million, which in today's terms would be more than $500 million. Wall Street panicked. The consensus was that American Express, as the parent company, would be on the hook for all of Allied's fraudulent liabilities. The fear was that this liability would be so large it would bankrupt the entire American Express Corporation. The stock, which had been trading at over $60 a share, plummeted. It fell by more than 50% to below $35. Analysts downgraded it, institutions dumped it, and the financial press wrote its obituary. The herd was thundering in one direction: sell. This is the moment where Buffett's genius shines. While everyone else was reading the panicked headlines and looking at the plunging stock chart, Buffett asked a simple, different question: is the underlying business being permanently damaged? He reasoned that the true value of American Express was not in its warehousing subsidiary, but in its powerful brand and the trust it commanded with consumers through its credit cards and travelers' checks. So he decided to become an investigator. He went out into the field to gather his own primary evidence. He visited restaurants and banks in Omaha. He talked to cashiers and tellers. He asked them if customers were still using their American Express cards. He asked if they had seen any drop-off in the acceptance of travelers' checks. The answer, everywhere he went, was a resounding no. Customers were oblivious to the salad oil scandal. They still trusted the little green card. The brand was intact. He realized that Wall Street's panic was completely disconnected from Main Street's reality. The market was pricing the company for bankruptcy, but its core profit engines were still humming along, undamaged. Convinced of his thesis, Buffett acted with incredible conviction. He invested 40% of his entire partnership's capital into American Express stock. It was the single largest investment he had ever made. It was a bet-the-farm moment. As he later explained, when you find a once-in-a-lifetime opportunity, you can't just dip your toe in, you have to back up the truck. Over the next few years, the market came to its senses. The salad oil liabilities turned out to be manageable, and the core business continued to grow. The stock price soared, and Buffett's partnership made a fortune. This story is the perfect encapsulation of the principle. The market's fear, driven by a dramatic but ultimately non-fatal event, created a massive gap between price and value. Buffett had the psychological fortitude to ignore the screaming herd and focus on the fundamental reality of the business. Buffett's ability to remain rational during the salad oil scandal stems from his intuitive understanding of two of the most powerful biases in behavioral science: loss aversion and herd behavior. The first, loss aversion, was famously identified by psychologists Daniel Kahneman and Amos Tversky in their Nobel Prize-winning work on prospect theory. In simple terms, they discovered that for the human brain, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This neurological asymmetry has profound implications for investors. During a market crash, as investors see the value of their portfolio shrink, they are not experiencing a calm, rational assessment of future probabilities. They are experiencing intense, visceral pain. The loss aversion instinct screams at them to, quote, make the pain stop, and the only way to do that is to sell. This is why people capitulate and sell at the bottom. They are not making a financial decision. They are making an emotional one, trying to anesthetize themselves from the psychological agony of seeing more red on the screen. This individual pain is then magnified exponentially by the second bias, herd behavior, also known as social proof. Humans are social animals. For millennia, our survival depended on our ability to stick with the tribe. When we see others running, our deep-seated instinct is not to stop and analyze the situation, but to run with them. In financial markets, this translates into a powerful cascade of selling. An investor might feel anxious, but they are holding on. Then they turn on the news and see panicked faces. They log into a forum and see thousands of posts about the coming apocalypse. Their neighbor tells them they just sold everything. The social proof becomes overwhelming. Their brain concludes, if everyone is selling, they must know something I don't. I have to get out now before it's too late. This creates a feedback loop, a self-fulfilling prophecy of collapse. Each seller reinforces the panic, creating more sellers, driving prices ever lower, completely disconnected from any underlying fundamental reality. Buffett's superpower is his immunity to these forces. His internal scorecard, as he calls it, allows him to completely disregard the herd. He is playing a different game, a game of logic and business analysis, while everyone else is playing a game of emotional survival. He understands that the very existence of the herd is what creates the opportunity. He is not smarter than everyone else. He is simply more emotionally disciplined. So how can an ordinary investor develop this kind of psychological armor? The key is to adopt a mental model that forces a shift in perspective during a crisis. Let's call this the journalist versus investigator framework. When a market crash happens, 99% of people instinctively adopt the role of the journalist. Their job is to report the news. They consume headlines, they watch the ticker tape, they listen to the pundits shouting at each other, they become experts on the fear itself. They can tell you exactly how many points the Dow is down, which bank is rumored to be in trouble, and what the latest terrifying prediction from a famous bear is. They are obsessed with the narrative of the panic. Their actions or inactions are dictated by this narrative. The result is paralysis or panic selling. To succeed, you must consciously reject this role and adopt the mindset of an investigator. An investigator is not interested in the headlines, they are interested in the evidence. Their job is to uncover the truth that lies beneath the noise. The investigator framework has 4 distinct steps. Step 1 is to mute the noise. This is the hardest but most important step. When a crisis hits, you must have the discipline to turn off the television, log out of the financial news websites, and ignore the cacophony of social media. The fire hose of fear-mongering is designed to trigger your most primitive reactive instincts. You cannot think clearly while it is blasting you in the face. Step 2 is to ask the fundamental investigator's question. What is actually happening to the underlying businesses? Forget the stock prices for a moment. Are people still drinking Coca-Cola? Are they still using their iPhones? Are businesses still running their operations on Microsoft software? In most systemic market crashes, the answer is yes. The daily habits of billions of people do not change overnight, even if the stock market has a seizure. Step 3 is to gather primary evidence, just as Buffett did in 1963. You don't have to visit restaurants yourself, but you can do modern-day equivalents. Read the quarterly reports of the companies on your watch list. Listen to their conference calls. Go to a store and see if people are still buying their products. The goal is to connect with the reality of the business, not the hysteria of the market. The final step is to formulate a thesis based on your investigation. For example, the market is pricing my favorite retail company as if it's going out of business, but my investigation shows that their stores are still busy and their brand is strong. The price is wrong. This simple process shifts your entire mental state from one of passive fear to one of active, rational inquiry. It allows you to see the panic not as a threat, but as a source of valuable information about where the market is most wrong. It is the core mental discipline of all great contrarian investing. The alternative to the investigator's path is the tragic and all too common journey of the emotional investor. This journey is a doom loop, a wealth-destroying cycle, powered by the very psychological biases we've discussed. It begins not in a crash, but at the peak of a bull market. The emotional investor, driven by FOMO and social proof, finally jumps into the market long after the easy money has been made. They buy the hot stocks at inflated prices, feeling euphoric as their initial investment goes up. They believe they are a genius. Then, the market turns. At first, there is denial. It's just a healthy correction, they tell themselves. But the decline continues. Denial gives way to anxiety. They start checking their portfolio obsessively, their stomach churning with each downward tick. The anxiety then curdles into fear as their losses mount and the media narrative turns apocalyptic. Finally, as the market approaches its bottom, the fear becomes unbearable. Loss aversion takes over completely, and they sell everything, often near the absolute lows. The dominant emotion is relief. The pain has stopped. They have crystallized their temporary paper loss into a devastating, permanent loss of capital. But the loop isn't over. They then sit on the sidelines, paralyzed, holding cash not as a strategic weapon, but as a symbol of their trauma. As the market begins its slow, uncertain recovery, they remain fearful, dismissing it as a sucker's rally. They wait for things to feel safe again. And by the time the market feels safe, it is, by definition, no longer cheap. It has made new highs. The headlines are positive again. And the emotional investor, their trauma faded and replaced by a renewed fear of missing out, finally buys back in, completing the doom loop. They have successfully executed the perfect anti-strategy: buy high, sell low. This is the path of the 99%, the default mode of the untrained financial brain. The financial implications of understanding this psychology are profound. When you buy a stock during a market panic, you are not just buying a share of a business. You are being paid a fear premium. This is a concept that doesn't appear on any balance sheet, but it is one of the most powerful sources of excess returns available to an investor. In normal times, the price of a stock is a reasonably rational estimate of its future discounted cash flows. But during a market crash, a new, irrational variable enters the equation: fear. The price of the stock is now its discounted future cash flows times a massive emotionally driven discount. This discount is your fear premium. It is the compensation you receive for providing liquidity and courage when both are in desperately short supply. We can see this quantitatively in valuation multiples like the price-to-earnings (PE) ratio. A great, stable company might trade at a PE of 25 in a normal market. In a severe bear market, it's not uncommon to see that same company, whose long-term earnings prospects haven't fundamentally changed, trade at a PE of 10. The earnings haven't been cut by 60%. The emotional tolerance of the market has. An investor who buys at a PE of 25 might expect a reasonable long-term return, but the investor who buys that same business at a PE of 10 has set themselves up for extraordinary returns. Not only will they benefit from the future growth of the business's earnings, but they will also benefit from multiple expansion, the PE ratio eventually returning from a fearful 10 to a more normal 25 as sanity returns to the market. This double-barreled return is only available to those who understand that they are not just buying assets, they are profiting from the predictable and cyclical nature of human fear. It transforms your view of a stock market crash from a destructive event into a rare and lucrative repricing of financial assets. Of course, recognizing the opportunity and having the cash to act on it is only half the battle. The bridge between the two is a quality that is in even shorter supply than capital during a crisis: patience. The ability to hold cash and do nothing, sometimes for years, while watching others seemingly get rich, is perhaps the most difficult and underrated skill in all of investing. This brings us to the third pillar of Buffett's philosophy: wielding patience as a superpower, the discipline of waiting for the fat pitch. Most of the investment world is addicted to action. They believe that being a great investor means constantly finding new ideas, making new trades, and rebalancing portfolios. Buffett's approach is the polar opposite. He believes that investing is most successful when it is most boring. It is a game not of sprinting, but of sitting. It requires the temperament to endure long periods of apparent inactivity, all the while knowing that you are preserving your capital and your mental clarity for the 1 or 2 moments when action is not just profitable, but essential. No episode in his career demonstrates this superhuman patience more clearly than his conduct during the greatest speculative mania of the 20th century, the dot-com bubble. The late 1990s were a time of wild abandon. The rise of the internet had unleashed a wave of euphoria unlike anything seen since the 1920s. Any company with .com in its name was rocketing to unimaginable valuations, regardless of its business model or profitability. It was a new paradigm, the pundits screamed. Traditional valuation metrics were obsolete. This time was different. And in the midst of this frenzy stood Warren Buffett, looking like a man out of time. He famously refused to buy the high-flying tech stocks. His reasoning was simple and unwavering. They were outside his circle of competence. He didn't understand their business models well enough to predict their long-term cash flows, and he certainly wasn't going to pay hundreds of times revenue for a company with no earnings. As the Nasdaq soared by 85% in 1999 alone, Berkshire Hathaway's stock lagged badly. The pressure on Buffett was immense. He was publicly ridiculed. The influential financial magazine Barron's ran a scathing cover story in 1999 titled, "What's Wrong, Warren?" The article declared him washed up, a relic of an old economy, a dinosaur who just didn't get it. Shareholders wrote him angry letters. So-called market experts proclaimed that his style of value investing was dead. Through all of this, Buffett did not flinch. He sat calmly in Omaha reading annual reports and drinking cherry Coke. He continued to buy shares in See's Candies and Coca-Cola. And most importantly, he let Berkshire's cash pile grow to tens of billions of dollars. He was finding nothing to buy that met his strict criteria of a great business at a sensible price. So he did the hardest thing an investor can do. He did nothing. He was willing to look foolish in the short term to avoid being a fool in the long term. He was waiting for the fat pitch, the one easy, obvious swing. He knew that in the game of investing, you don't have to swing at every pitch. You can wait and wait and wait for the perfect one to come right down the middle of the plate. Then, in March of 2000, the bubble popped. The fall was as swift and brutal as the rise had been euphoric. Companies that were market darlings just months before went bankrupt. The Nasdaq Composite Index, the symbol of the new economy's invincibility, lost nearly 80% of its value over the next 2 years. The paper fortunes of millions of investors were wiped out. And Warren Buffett? He was fine. Berkshire Hathaway's stock, buoyed by its solid, profitable, old economy businesses, held up remarkably well. His discipline had been vindicated in the most spectacular fashion. The cash he had patiently accumulated was now an enormous treasure chest in a world where capital was suddenly scarce and assets were cheap. He had traded the fleeting thrill of participating in a mania for the enduring power of survival and opportunism. His patience was not passive. It was a powerful, deliberate, and ultimately triumphant strategic choice. This extraordinary discipline is not something you are born with. It is a mental muscle that can be trained. The psychological principle, at its core, is the capacity for delayed gratification. This was famously demonstrated in the marshmallow test, a series of studies conducted at Stanford University in the 1960s and 70s. A child was placed in a room with a marshmallow on a plate. The researcher told the child they could eat the marshmallow now, but if they could wait for 15 minutes until the researcher returned, they would get 2 marshmallows. Follow-up studies over decades found a stunning correlation. The children who were able to delay gratification and wait for the second marshmallow went on to have higher test scores, better health outcomes, and greater success in their careers. Investing is a giant, lifelong marshmallow test. The market constantly dangles one marshmallow in front of you, the small, quick, exciting gain from chasing a hot trend or a momentum stock. The 2 marshmallows are the massive, life-changing returns that come from patiently waiting for a great business to go on sale during a panic. The force that drives us to grab the first marshmallow is the fear of missing out, or FOMO. This is the evil twin of loss aversion. It's a powerful social anxiety, supercharged by the 24/7 news cycle and social media, that we are making a mistake by not participating in what others are doing. When your friend tells you about the killing they're making in a new cryptocurrency or a hot tech stock, your brain's FOMO circuit lights up. It whispers that you are being left behind, that you are a sucker for sitting on the sidelines in boring cash. Buffett's antidote to FOMO is his concept of the internal scorecard. He judges himself not by what others think of him, or by comparing his short-term performance to a benchmark, but by whether he is adhering to his own rational, time-tested process. He is running his own race. The external scorecard, the Barron's article, the lagging stock price, is just noise. By focusing on his internal scorecard, he is able to resist the siren song of FOMO and stick to his discipline, patiently waiting for the 2 marshmallow opportunity that he knows, with absolute certainty, will eventually arrive. To operationalize this kind of patience, we need a mental model that forces discipline and selectivity upon us. The most powerful one Buffett ever shared is the 20-slot punch card rule. He said that when you are starting your investing career, you should imagine that you have been given a punch card with only 20 slots on it. Each time you make an investment, you have to punch a hole. For your entire life, you only get 20 punches. That's it. This simple thought experiment has a profound effect. It immediately raises the bar for what constitutes an acceptable investment. You are no longer looking for something that might go up a little bit. You are looking for a true fat pitch, a high-conviction idea that you are willing to dedicate one of your precious few slots to. It forces you to do deeper research, to think in terms of decades rather than quarters, and to say no to 99.9% of the ideas that come across your desk. The 20-slot punch card blueprint can be implemented in 4 steps. Step 1. Define your circle of competence with brutal honesty. What businesses and industries do you genuinely understand on a deep level? It's better to have a small, well-defined circle than a large, superficial one. If you can't explain how a business makes money and why it will still be making money in 10 years, it's outside your circle. Stay away. Step 2. Within that circle, create your watch list. This is your fat pitch list. The 10 to 15 companies you've identified as truly superior businesses that you'd be thrilled to own. Step 3. For each company on the list, calculate your no-brainer buy price. This isn't a precise intrinsic value calculation down to the penny. It is a price that is so obviously cheap, that offers such a large margin of safety that you would not hesitate to punch your card. As Buffett says, it's better to be approximately right than precisely wrong. Step 4, and this is the key to the entire model. Do nothing. Your job now is to simply monitor your watch list and your cash level. You wait. You could wait for months, you could wait for years, but you do not swing until the market, in a fit of depression or panic, serves up one of your companies at your price. This model transforms investing from a hyperactive game of speculation into a disciplined process of patient capital allocation. It cures the addiction to action. The antithesis of the 20-slot punch card investor is the hyperactive trader. This individual is the embodiment of the 99% path. They fundamentally believe that activity equals progress and that their intelligence can allow them to outsmart the market on a day-to-day basis. Their behavior is predictable. They check their portfolio 20 times a day, their mood rising and falling with the meaningless squiggles on the screen. They are constantly chasing narratives. This month it's AI, next month it's weight loss drugs. Their portfolio is a revolving door of half-baked ideas, never giving a true long-term investment the time to compound. They are a fee generation machine for their broker, paying commissions on every trade. They are a revenue generation machine for the government, paying high taxes on their short-term capital gains. They read a headline in the morning and place a trade in the afternoon. They mistake the adrenaline rush of trading for the sober process of investing. The tragic irony is that study after study has shown that the more an individual investor trades, the worse their returns are. The hyperactive trader is running on a hamster wheel, mistaking motion for forward movement, all while a patient Buffett-style investor sits still, conserving their energy for the one leap that will carry them miles ahead. This path of constant action, of trying to outsmart everyone else every day, is a direct route to financial disappointment. The financial connection here is one of the most powerful and counterintuitive truths in wealth building, the compounding of inactivity. The cost of hyperactivity is not just the obvious friction of commissions and taxes, but the far greater cost of missing out on the magic of long-term compounding. Let's imagine our two investors again. Investor A, the patient punch card investor, and Investor B, the hyperactive trader, both starting with $100,000. Over a 20-year period, Investor A makes only 5 investments, punching their card 5 times. Each investment is a great business, bought during a period of market distress. They hold these investments for the entire period. Investor B makes 200 trades over the same period, perhaps 10 trades per year. They have some wins and some losses. They are constantly trying to time the market, selling what's cold and buying what's hot. At the end of the 20 years, the results would not even be close. Investor A's portfolio, powered by the uninterrupted compounding of a handful of great businesses, would likely be worth many multiples of its original value. Investor B, their returns eaten away by taxes, fees, and the high probability of being out of the market on its best recovery days, would be lucky to have kept pace with a simple index fund. More likely, they would have significantly underperformed. The great secret that Wall Street doesn't want you to know is that fortunes are not made in the buying and selling. They are made in the sitting. Patience doesn't just feel better, it pays better. The discipline to hold cash, to wait for the fat pitch, is a direct and quantifiable contributor to long-term portfolio outperformance and the successful creation of generational wealth. We have now established the importance of holding cash as an offensive weapon, the psychological necessity of acting against the herd, and the profound discipline required to wait for the perfect moment. But when that moment finally arrives, when the storm is raging and the fat pitch is coming over the plate, how does one actually swing the bat? This brings us to the fourth pillar, executing the strike. This is about the practical mechanics of deploying capital in a crisis. It's not enough to have the gun loaded. You have to know what to aim at and when to pull the trigger. During a market crash, indecision is fatal. The window of opportunity, when assets are truly mispriced, can be brutally short. Having a clear framework for action is what separates the masters from the paralyzed masses. And there has never been a greater masterclass in crisis execution than Warren Buffett's performance during the darkest days of the 2008 global financial crisis. The fall of 2008 was a time of unprecedented fear. The global financial system was on the verge of complete collapse. Lehman Brothers, a 158-year-old institution, had just filed for bankruptcy, sending shockwaves through the entire system. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. It felt like the end of the world. In this environment of absolute terror, Warren Buffett was not hiding. He was hunting. He was on the phone, taking calls from the CEOs of the most powerful companies in America who were suddenly desperate for capital. Two deals from this period perfectly illustrate his execution strategy: his investments in Goldman Sachs and General Electric. On September 23, 2008, just a week after Lehman's collapse, Buffett announced a $5 billion investment in Goldman Sachs. This was not a simple stock purchase. This was Buffett, the ultimate opportunist, using his immense leverage to craft a deal of a lifetime. He received $5 billion worth of preferred stock that paid him a perpetual 10% dividend. That's $500 million a year, guaranteed, for as long as Goldman kept the stock outstanding. On top of that, he received warrants giving him the right to buy $5 billion of Goldman's common stock at a strike price of $115 per share, exercisable at any time in the next 5 years. Let's break down the genius of this structure. The preferred stock gave him immense downside protection. He was first in line to get paid, and the hefty dividend was his reward for taking the risk. The warrants, however, gave him all the upside. If Goldman survived and recovered, as he was betting it would, the warrants would be worth billions. He was getting paid handsomely to wait for the upside. This deal was about more than just money. Buffett was providing his ultimate asset, his reputation. The Buffett stamp of approval was a signal to the world that Goldman Sachs was going to make it. The news of his investment immediately stabilized the firm's stock price and restored a measure of confidence to the entire financial system. Just a week later, he did it again, striking a similar deal with General Electric, another blue-chip giant teetering on the brink. He invested $3 billion in GE preferred stock, paying a 10% dividend, and again received warrants. In the years that followed, these two deals alone made Berkshire Hathaway over $10 billion in profits. This was the pinnacle of crisis investing, using a mountain of cash prepared long in advance to act with speed, scale, and surgical precision, structuring deals that offered equity-like returns with bond-like safety. He was not catching a falling knife. He was forging a financial masterpiece in the fires of global panic. What Buffett demonstrated in 2008 was the ability to overcome a powerful psychological barrier that freezes most investors in a crisis: analysis paralysis. When fear is rampant and every stock is down 50% or more, the paradox of choice kicks in. Where do you even begin? The fear of buying a stock that continues to fall, of catching a falling knife, becomes overwhelming. Most people, even those with cash, are so terrified of making the wrong decision that they end up making no decision at all. Buffett overcomes this through a combination of extreme preparation and a ruthless focus on a few simple, powerful criteria. He is not trying to analyze the entire market. He is not trying to find the next hot tech company. He is relying on the decades of work he has already done to identify great businesses. His watch list is already prepared. When the crisis hits, he is not starting his research from scratch. He is simply checking the price tag. He has a deep, unwavering confidence in his own analysis of a business's long-term value, which allows him to ignore the short-term, fear-driven price action. This pre-preparedness is the antidote to paralysis. It allows him to act with the decisiveness of a battlefield commander while everyone else is huddled in a foxhole. To translate this into a practical mental model for the individual investor, let's create the financial first responder protocol. Imagine you are an emergency medic arriving at the scene of a major accident. Your job is not to panic, but to triage. You must quickly assess the situation and allocate your resources to where they can do the most good. The same applies to a market crash. Step 1 is triage the market. You must mentally separate the universe of beaten-down stocks into 3 distinct buckets. Bucket 1 contains the mortally wounded. These are the companies whose business models have been genuinely broken by the crisis, or whose balance sheets are so weak they are likely headed for bankruptcy. Think of Lehman Brothers in 2008. Your job is to avoid this bucket at all costs. You are an investor, not a gambler. Bucket 2 contains the walking wounded. These are fundamentally good, even great, businesses that have been severely injured by the crisis, often due to taking on too much debt. Goldman Sachs and GE in 2008 are perfect examples. These can be incredible opportunities, but they require a deeper level of analysis and a higher tolerance for risk. Bucket 3 contains the healthy but terrified. These are the world's greatest businesses, the ones with fortress-like balance sheets and unshakable competitive advantages that are simply being sold off in the general market panic. Think of Coca-Cola or Johnson & Johnson in a market crash. Their stocks are down 30 to 40%, not because their businesses are in trouble, but simply because they are part of the overall market that is being liquidated. Step 2 of the protocol is to focus your firepower primarily on Bucket 3 and secondarily on Bucket 2. For most retail investors, the highest probability, lowest stress path to wealth is to buy the healthy but terrified. You are buying world-class assets at a temporary discount. Step 3 is to think like Buffett and structure your deal. While you can't get preferred stock and warrants, you can apply the same logic. This means insisting on a massive margin of safety. You only buy when the price is so far below your estimate of intrinsic value that you have significant downside protection built in. You are not trying to buy at a fair price. You are trying to buy at a ridiculously cheap price. Step 4 is to act with speed and scale. When a company from your watch list hits your predetermined no-brainer price, you do not nibble. You do not buy a small starter position. You make a meaningful investment. This is a core tenet of effective capital allocation. You have waited patiently for this fat pitch. When it comes, you must swing hard. This protocol provides a clear, logical framework that cuts through the emotional fog of a crisis, enabling decisive action when it matters most. The antithesis of this decisive protocol is the fool's errand of trying to catch the exact bottom. This is one of the most common and costly mistakes that aspiring contrarian investors make. They correctly identify that the market is cheap and that it's a good time to buy. They have their cash ready, but they are seduced by the allure of perfection. The market drops 30% and they think, "This is great, but maybe it will drop to 40%. It drops 40% and they think, "I'll wait for the capitulation of a 50% drop." Then, one day, the market turns. It rallies 5% in a single session. The bottom catcher tells themselves, "It's just a dead cat bounce. I'll wait for the retest of the lows." The market rallies another 10%. Now they are in a psychological trap. They feel like they've missed the initial move, so they refuse to buy at these higher prices. Before they know it, the market is 30% or 40% off its lows, and their window of opportunity has slammed shut. In their quest for the perfect entry point, they have missed an excellent one. Their greed for the last 10% of the drop has cost them the first 40% of the recovery. Buffett has always said he is not good at predicting the market's short-term movements. He does not try to buy at the absolute bottom. He simply starts buying when prices become sensible and continues to buy as they become even more sensible. The goal is not to be perfect. The goal is to be in the game. Trying to catch the bottom is an act of ego. Executing a disciplined protocol is an act of intelligence. The direct financial connection of mastering this execution is the capture of asymmetrical returns. The math of recovering from a crash is not intuitive, and it massively favors the crisis investor. If a stock falls from $100 to $50, it has lost 50%. But to get back to $100, it needs to rise 100%. If a stock falls from $100 to $20, an 80% loss, it needs to stage a 400% rally just to get back to even. The investor who held the stock all the way down and all the way back up has made nothing. They have simply endured a gut-wrenching round trip. But the investor who had cash and bought that same stock at $20 has made a 400% return on their capital. They have quintupled their money. This is the staggering asymmetry of crisis investing. You are risking the last 10 to 20% of the downside in exchange for a potential 200%, 300%, or even 500% of upside. Let's look at real-world examples from the 2008 crisis. If you had bought shares of Bank of America in the dark days of early 2009, you could have seen your investment increase by more than 1,000% over the next decade. Ford Motor Company, which fell below $2 a share, roared back. These were not obscure penny stocks. They were pillars of the American economy, priced for extinction. The ability to execute during these brief windows of terror is not just an incremental advantage. It is the single most powerful mechanism for wealth acceleration available to any investor. It is how fortunes are made. It's the moment your entire financial future can be rewritten, all because you had a plan and the courage to execute it when everyone else was running for cover. We have now journeyed through the core of the strategy, reframing cash as an offensive weapon, understanding the psychology of panic, mastering the discipline of patience, and knowing how to execute the strike. The final step is to integrate these pieces into a coherent, lifelong system. This brings us to our fifth and final pillar, building the fortress. This is about how an ordinary investor can and should weave the principle of strategic cash into their overall portfolio strategy. It's about moving from a series of opportunistic trades to a durable, all-weather wealth management philosophy. This isn't about one single event. It's about an operational posture that you maintain for your entire investing life. The best way to visualize this is not through a single anecdote, but by looking at the living embodiment of this philosophy, the balance sheet of Berkshire Hathaway itself, over many decades. If you were to chart the level of cash and short-term treasuries on Berkshire Hathaway's balance sheet over the past 30 years, you would see a pattern that is the perfect inverse of market sentiment. The cash pile builds and builds during the late stages of a bull market. In the late 1990s, as the dot-com bubble inflated, Berkshire's cash hoard swelled to tens of billions, prompting the criticism that Buffett had lost his touch. Then, after the crash of 2000 to 2002, that cash was deployed, and the balance shrank. Again, from 2005 to 2007, as the housing and credit bubble grew, the cash pile steadily climbed, reaching new heights. Then came 2008, and in a matter of weeks, Buffett deployed tens of billions of dollars, and the cash balance plummeted. In the years since, during one of the longest bull markets in history, the pattern has repeated. As valuations became more and more stretched, Buffett found fewer and fewer things to buy at prices he considered reasonable. The cash pile has grown relentlessly, recently reaching an all-time high of over $180 billion. This fluctuating cash balance is the heartbeat of Berkshire Hathaway. It is a living record of his discipline and his opportunism. It grows when fear is scarce and greed is abundant. It shrinks when greed turns to fear. This is not a market timing strategy. It is a price and value strategy. The cash balance is simply the byproduct of a rational, disciplined capital allocation process. He is not predicting rain. He is simply building the ark. This lifelong rhythm of accumulation and deployment is the ultimate model for building a financial fortress that can withstand any storm and capitalize on any crisis. For an individual investor, implementing this strategy requires overcoming a few final psychological hurdles. The first is the endowment effect, the tendency to place a higher value on something simply because we own it. This bias makes it difficult to sell an appreciated stock, even if it has become overvalued, to raise strategic cash. We become emotionally attached to our winners. The second hurdle is mental accounting, the habit of putting our money into different mental buckets that have irrational rules attached. Many investors have a mental bucket labeled brokerage account, and the rule for that bucket is that all the money inside it must be invested in stocks. Seeing a large cash balance in that account feels wrong, like the money is being lazy. To build a true fortress, you must break these mental models. You must view your entire portfolio as a single, cohesive entity and be willing to trim overvalued positions, no matter how much you love them, to raise the capital that will fund your future opportunities. You must create a new mental account, the Strategic Opportunity Fund, and understand that the cash in it is not lazy, it is working harder than anything else, patiently waiting to seize the future. A powerful and practical mental model for implementing this at the retail investor level is the barbell strategy, a concept championed by Nassim Taleb. This approach is designed to be both extremely robust and highly opportunistic, the perfect embodiment of the Buffett cash principle. Imagine a barbell with weights on either end and nothing in the middle. Step 1 is to construct the first side of the barbell. This side contains 80% to 90% of your investment capital, and it is dedicated to being extremely safe and conservative. For most people, this would mean a globally diversified portfolio of low-cost index funds. This is your don't lose pile. Its purpose is to capture the general long-term growth of the global economy and protect you from ruin. You do not tinker with this side. You do not try to pick stocks here. You just let it compound steadily and reliably over time. Step 2 is to construct the other side of the barbell. This side contains the remaining 10% to 20% of your capital, and it is dedicated to being extremely aggressive and opportunistic. And what is the ultimate aggressive, opportunistic asset? It is cash, your strategic opportunity capital. This cash is not for safety. Its purpose is purely offensive. It is the venture capital portion of your portfolio, waiting to be deployed into the healthy but terrified bucket during a full-blown market panic. Step 3, and this is crucial, is to have nothing in the middle. You avoid the medium-risk assets, the complex structured products, the high-yield bonds, the highly speculative individual stocks that often give you the worst of both worlds. More risk than your safe side, and less upside than your opportunity side. The barbell strategy gives you a portfolio that is incredibly resilient. The safe side ensures your survival and participation in long-term growth. The cash side gives you the explosive upside potential that can only be captured during a crisis. It is a lifelong asset management framework that is simple to understand, easy to implement, and psychologically robust. It systemizes the process of having dry powder and protects you from your own worst emotional instincts. The antithesis of the fortress builder is a surprisingly common but dangerous investor archetype, the permabear. The permabear is the investor who correctly predicts a crash once and then spends the rest of their life waiting for the next one. They might have brilliantly called the 2008 crisis, sold everything at the top, and felt like a genius. But then, their fear gets the better of them. They sit in cash through 2009, 2010, and 2011. Convinced that the recovery is fake and that the real crash is just around the corner. They miss one of the greatest bull markets in history, watching from the sidelines as the market doubles, triples, and then quadruples. The permabear understands the defensive aspect of cash, but they completely fail to grasp its offensive purpose. They build the ark, but they are too afraid to ever disembark after the flood. Their one correct prediction becomes a psychological prison, leading them to miss out on years or even decades of compounding growth. They have won a single battle but lost the long-term war for financial freedom. This is a subtle but tragic path to underperformance, a warning that holding cash is not an end in itself, it is a means to a greater end. And what is that greater end? It is the profound and tangible impact that this strategy has on your long-term net worth and your journey to financial freedom. Let's model 3 investors over a 30-year career that includes several full market cycles. Investor A is the always fully invested believer. Investor B is the hyperactive trader. Investor C is the barbell strategist who maintains a 15% strategic cash position and redeploys it during major market downturns. After 30 years, the results would be a dramatic illustration of this entire philosophy. Investor A would likely have done reasonably well, perhaps tracking the market averages. Investor B would almost certainly be the laggard, their returns decimated by fees, taxes, and bad timing. But Investor C would be in a different league altogether. The periodic, powerful boosts they received by deploying cash at market bottoms would have a massive compounding effect over time. Each crisis would serve as a rocket booster for their portfolio, launching it to a new, higher plateau. The final numbers would show that their portfolio value is not just a little higher but potentially double or triple that of the others. This is the ultimate financial connection. This strategy isn't about eking out a few extra percentage points of return. It is a fundamentally different and more powerful engine for wealth building. It is the key to achieving true financial freedom faster and with far less stress, because you have a system that is built to thrive not just in spite of volatility, but because of it. You have just invested a significant amount of your most valuable asset, your time, to acquire a powerful mental tool. You have moved beyond the simplistic platitudes of personal finance and have begun to understand the machinery of wealth creation at the highest level. You now see that cash is not a sign of fear, but a tool of power. You understand that market crashes are not disasters to be survived, but opportunities to be seized. This knowledge, once internalized, will permanently change the way you view your portfolio, the financial news, and the very nature of risk. You have acquired a foundational piece of the puzzle. But the most effective systems in the world are not single pillars. They are interconnected networks of mental models. What we have just constructed is the capital allocation engine of the Buffett philosophy. We have built the cannon and stocked the ammunition. But an equally critical question remains. When you fire that cannon, what exactly are you aiming at? Knowing when to buy is half the battle. Knowing what to buy is the other half. The strategy of holding cash is inseparable from the strategy of identifying truly wonderful businesses, companies with durable moats, honest management, and long-term earning power. Having the cash without the wisdom to deploy it into the right assets is like having a Formula One car without knowing how to drive. The video that is now appearing on your screen is the missing link. It is the next piece of the map. It bridges the gap between capital allocation and business analysis. It takes you from being a brilliant market strategist to being a brilliant business analyst, completing the circuit of the value investing philosophy. This journey is not for everyone. Many will be content with the surface-level knowledge. But for those who are serious about building not just wealth but a fortress of financial independence, the journey must continue. The click you are about to make is not just a click to watch another video. It is a conscious decision to continue your ascent. It is a declaration that you are committed to mastering the complete mental arsenal of the world's greatest investor. Complete the fortress. The choice is yours.